Resource-rich countries usually require oil or gas or mining companies to pay taxes. However, most of the time governments allow companies to deduct their business expenses from the amount they owe. These are the goods and services that the companies themselves do not have or produce, so they buy them from someone else. Sometimes a different part of the same company already has or makes that stuff, and it can just be transferred from one part of the company to the other. The people within the company still count the transfer as money spent and money made so they can stay organized. So where's the problem? Normally, the price for the stuff that one part of the company charges the other is close to what a company would pay anywhere else, the fair market value. This is called the arm's length principle. The problem comes with transfer mispricing. A company thinks about the taxes it will have to pay in the countries where it's working, and it wants to pay less, much less, than it should. So it uses its business expense tax allowance unfairly. These companies buy the stuff in-house, but they set a very different, much higher price from the fair market value, one that will change how much in taxes the company owes the government. Because if the cost is too high, the unit can claim that because of these terribly high expenses, there was almost no profit and they don't owe that much in taxes. Or maybe a big company uses its subsidiaries to change the numbers when selling the stuff. A subsidiary is a company that is at least half owned by a bigger company. There are several ways they do it, and here's one. A company subsidiary, the first company subsidiary, sells the raw materials from a poor country where they have to pay taxes to another company subsidiary in a second country where they don't have to pay so much in taxes, and they sell it at a ridiculously low price. That second subsidiary will turn around and sell it for a lot more and make a huge profit. But the first subsidiary will go to the government of the poor country and say, "We didn't get that much for the stuff, so we don't owe you that much in taxes." There are many other creative ways companies disguise the true price of what they buy and sell to shortchange the tax man. Of course, many companies do not do this, and they try to be as fair as possible while still protecting their profits to the extent allowed by law, but a surprising number do not. The problem is that finding the mispricing takes a ton of work and time from the government accountants who have to figure out where the cheating happened and how much was really involved, and many countries simply do not have the resources to do it.